Many people live daily lives deeply influenced by credit, yet most never see its direct effects, which means credit operates as a largely invisible force shaping economic behavior and opportunities around them. This invisibility is surprising because credit fundamentally expands purchasing power beyond current income, creating a hidden layer of financial activity that often goes unnoticed in everyday transactions. Credit works by allowing lenders to create deposits through loans, which increases money supply temporarily so people can buy goods or services now and pay later, linking future income to present spending. Lenders provide credit because they expect repayment with interest, which creates incentives to assess borrower risk carefully, shaping who gains access to credit based on perceived ability to repay. Borrowers, motivated by the immediate benefit of spending power, often accept future payment obligations, which means credit choices balance current desires against future constraints. Because credit expands purchasing options, it often leads to higher consumption than cash alone would allow. But this increased spending is limited by lenders' risk controls and borrower repayment capacity. The availability of credit influences decisions beyond buying, affecting saving habits and investment choices, since access to funds at different times changes how people plan their economic activities. Credit also impacts prices in markets because when more buyers can use credit, demand increases, which can push prices higher, creating a feedback loop between credit availability and market dynamics. The risk that borrowers might default leads lenders to impose conditions like interest rates and credit limits, which serve as incentives to encourage responsible borrowing and mitigate potential losses. This risk management creates trade-offs where extending credit too freely can provoke defaults, while restricting credit limits economic activity, illustrating the balance lenders seek between growth and stability. Because credit relationships rely on trust and information, the system incentivizes the development of credit histories and ratings, which affect future borrowing opportunities and economic behavior. Credit's influence extends beyond individuals to affect business operations, since firms often rely on credit to manage cash flows, invest in projects, and smooth income fluctuations. This business use of credit means economic growth often depends on credit expansion, but excessive reliance can lead to vulnerabilities if repayment expectations are not met. Credit cycles emerge because lenders' willingness to extend loans varies with economic conditions and perceived risks, producing periods of expansion and contraction that shape broader economic trends. The invisible nature of credit means that many participants underestimate how much their financial decisions depend on credit availability and terms, affecting individual and collective economic outcomes. Government policies and regulations also influence credit by setting rules for lending practices, consumer protections, and capital requirements, which shape incentives for both lenders and borrowers. These policy constraints aim to balance encouraging credit access with minimizing risks, which means credit markets operate within a framework of trade-offs between growth and safety. Credit's indirect effects ripple through the economy, influencing employment, production, and income distribution, as access to credit affects who can invest, consume, or seize opportunities. Because credit can amplify economic cycles, it may contribute to booms and busts, reflecting the tension between short-term incentives to lend and longer-term risks of default. Understanding credit as a system of incentives and constraints reveals it as a critical mechanism that shapes economic choice and resource allocation rather than a simple financial tool. Credit's invisibility masks its role in connecting present consumption with future repayment, creating complex interdependencies that influence economic stability and individual behavior. This mechanism explains why credit availability can differ widely across populations and regions, reflecting variations in risk assessment, economic conditions, and institutional frameworks. Recognizing credit as a dynamic system shaped by incentives and constraints helps clarify why it is both essential for economic activity and a source of systemic risk. Ultimately, credit operates quietly behind the scenes, shaping economic life by linking current possibilities to future obligations, which means its influence is profound even when unseen.